Okay.
Hello, ladies and gentlemen. Super duper happy being here today with Alex, the greatest smart strategy system. So Alex, first of all, it's a pleasure having you here on our show, the TradePod. And actually, before that, I will give a short introduction about the conversation that we're going to be having right now. I would like
Which is
to
going to be
thank you for
fascinating.
participating. Yeah, first of all, of course, it's gonna be fascinating. Our entire episodes are fascinating. But this one is gonna be incredibly fascinating because Alex is about to reveal his smart trading system and how he approaches the market. So, without further ado, Alex, it's a pleasure having you here on the pod. Please let the viewers know who you are and how you will contribute them.
Thank you. First of all, I would like to thank both of you for having me as a guest
Cheers to
i-
you, mate.
in your in
Cheers
your
to you.
Obviously.
fantastic podcast. And this is the
It
I
is
believe,
fantastic.
and it's very nice that we'll be actually making a video out of it. So I'm really happy to be here with you. I'm looking forward to a very fruitful conversation that your viewership will enjoy. So my journey in life, well, I'm 50 years old. My passion in market started my journey in market started very early on, around say 15 years old. My father was working in Bank of America, so he took a journey in England. He was working in Greece, so he took a journey in England. He went to a Bank of America dealing room, so he was impressed there. So he said, son, something, because he was working in corporate finance. So he said, you should go into trading and work in a dealing room. And as a child, I would like to impress their father. I said yes, although I didn't know what a dealing room was. But I found myself attracted to uh, finance. So I went to university, City University, did a bank international finance in City University, and so that was the first turning point in my career. The second one was during the last year of my studies. The last year of my studies, I had a professor called Roy Batchelor, who actually um, we're still in contact with, and Roy was a pit trader. Now he turned academic, and but he because he had the trading background, he was actually doing technical analysis. Now, at that time, when I say at that time, I mean 1995, 96, so it was a long time ago, the technical analysis community wasn't as accepted. It was considered a bit heresy in the academic community. So, but he wanted to teach it. So what did he do? So he sandwiched the technical analysis into some econometrics at the beginning, some econometrics at the end. Called it forecasting. So that was the first time that technical analysis was taught in a British university. I took that as an elective module, but that was the first time I saw technical analysis, and I fell in love with it in 1995, late 95, beginning of 96. So that was my journey in technical analysis. Since then, I did my military service, worked in in a couple of hedge funds, worked in proprietary trading firms, very management firms. I started as a stock trader, then became a futures trader, global market. I found myself that I was more interested in macroeconomics rather than microeconomics. Went through my first bear market in 1998. Um, and a couple of other ones subsequently. All of them was useful lessons. And then at a later stage, gave up my corporate career or life and decided to become a prop trader, solely trading my own book. And during the past couple of years, I've had a lot of requests to show what I do, because in the meantime, of course, I skipped a lot of steps in my career. For example, in 2010, I was approached by John Bollinger to launch the UK chapter of the then Market Technicians Association, the CMT Association as it's rebranded itself. It's the biggest technical analysis association globally, to launch the UK chapter. Through that was a fantastic experience for me, because I had to brush up, actually learn a lot of management skills, organize the technical analysis community in London. Through that, I met a lot of fantastic people, like people like Larry Williams, Tom DeMark, Linda Rasky, John, of course, and many, many others who are not that famous, but are equally knowledgeable, if you will. And 2002, I wrote a paper called MACD Volatility Normalized Momentum, which I submitted to two organizations. One's the CMT Association, which organizes a best research competition called the Charles Dow Award, and also the National Association of Active Investment Managers, which organized again a research competition called the Founders Award. And I submitted that paper, and it won first prize for both associations, for introducing volatility normalized momentum, which was a bit of a breakthrough. The backstory of that competition was that I never intended to enter it, in the sense that I made the discovery in 2015 and have been using that technique ever since. But then it came a point where I wanted to just disclose it, in the sense of, share it with the community. But instead of just, putting it on blogs, or I thought, okay, I'll write it as in the form of a paper, and I'll put it, say, on SSRN. And then I saw the competitions. I said, okay, I might as well, give it some kind of like recognition. And it won the first prize for both awards, and it created a lot of publicity for me. Well, actually, publicity has been coming through, of course, the 2010 through the MTA. Then I started through that getting invited to a lot of conferences and do presentations, and then the paper as well. So it's like gradually I've been getting a bit more well known, if you will. And through that, now I got a lot of requests. I mean, a lot of requests to teach volatility normalized momentum and the MACD. So I will be launching very shortly a community where I can be sharing my work. Although the vast majority of people know me for that, I don't want to be pigeonholed as someone who just uses volatility normalized momentum, but a whole of other tools, like combining technicals and fundamentals. Perhaps we can touch upon it a bit later on. So that's the story of my life in a very brief and hopefully not boring
it's not boring at all.
summary.
Yeah, this is fascinating. I mean, you threw through a lot. I mean, definitely, you won a prize in 2015, and you won the prize at
2022, a couple of years back. Yeah,
like 7 years.
It was 2015. I made the discovery in 2022. I published it and made the awards. To tell you the truth, I mean, I was doing a lot of work from 2015 on volatility on MACD and volatility normalized momentum. So when it got to 2022, I had done so much work on it that even just what I published, because obviously it was a paper, couldn't be a book. So it had to be a very small subset of that. But because of the work I had done up until that point, to me, it seemed very basic and insignificant. But to the technical analysis and trading community was something significant. I'm very glad. And it goes to show you, it's also a lesson about human psychology, because the thing is familiarization. I mean, the more you do something, you just take it for granted. It's not something much. But it was a bit of a breakthrough because, basically I took an indicator, the second most well-known momentum indicator. If the first one is RSI, the second being the MACD, and dissected it five basic challenges that it has, 5 limitations, and I improved upon them. 3 were disclosed in the paper, 2 I haven't. I'll be doing a more advanced version of the MACD later on and publishing it on various technical analysis platforms.
Got it. So about your technique, about your smart technique. Let's do it.
Yeah. Well, basically, well, I developed it's a system. It's a trader development system because in one of the well, a bit of a background. One of the previous works I had in one of the funds I was working, we decided to set up a proprietary trading desk. So part of my duties, other than managing the firm's one of the firm's books, was to develop traders. Bring in young traders who would be trading firm capital, and then if they were good enough, will be trading client capital. So the question arose on how to develop a trader, how to teach them. So that question was effectively answered by okay, if I could teach myself, knowing what I know, I could go back in 2000 when I started in 1998. How could I teach young Alex everything I know? So if I could give myself a call, say 26 years back, what would I do? So this is what I try to teach, but with a few twists. First of all, I would like to classify the stages of trader development. So this formed the acronym SMART because there are 5 stages of trader development, I think. The first one is the stage of self-knowledge. This is where the S in the SMART comes from. And self-knowledge basically is the evaluation of someone if they should go down the path of becoming either proprietary or part-time or professional trader, to simply evaluate what they're good at, what they're not good at, and what the trip entails. Now, there are 4 factors to look at the first stage. They form the acronym GROW. It's like, what are your goals, the realities, again, the obstacles in this trip and your will. So again, that's like probably would take us an hour to go through the self-evaluation because you need 4 types of capital: time capital, financial capital, knowledge capital, and emotional capital, in the sense of like support both from family or your spouse or friends, and also a support network like with fellow traders and also a mentor. Again, there are 4 types of capital you need. And so this is the first stage, the stage of self-awareness, self-knowledge. The second stage, if someone decides that they have what it takes and they want to give it a shot, is the M of the SMART, which is after self-knowledge comes into market knowledge. Now, so market knowledge basically means learning the technical analysis, bit of fundamental analysis, the factors, the key drivers of price movement, because you've got intrinsic and extrinsic. For example, you've got price itself, technical analysis, and the factors that shape price movement, because prices go from point A to B, not for technical reasons, but for fundamental. We watch the journey from point A to point B through technical analysis, but prices move for a reason. Now, there is a lot of noise in between. Not everything is fully explainable through technicals or fundamentals, but there is an explainable part to it. So that's the M of the SMART model, market knowledge. The second one is an action plan, a trading plan. So basically take all that and form it into an action plan, like a trading plan. So this is where the parts where most traders fail, if you will. And then you've got the 4th stage, which is the R and the SMART, which is repeat and review, because you may have a trading plan, but you must practice, putting it from theory to practice. So market knowledge, as we said about the M, is knowing about the ingredients, the flour, the butter, and the milk. The A, the action plan, is basically taking that and making a recipe. But having a recipe does not make you a cook. So one must practice. So that's where the R comes, the how to practice, how to work on a simulator, what are the criteria, the quantitative criteria to monitor your performance, to go from demo, from a sim to live, or how to scale from one strategy, gradually start adding strategies, or gradually adding markets, focusing on one thing at a time. So once you've done that, the T stands for trade live. So how you can actually go from that point to actually
Being
launching
consistent
a strategy with live
profitable.
markets, and also how you can start scaling it as well. So this is the smart trader development. This is basically the smart trader system, which is the 5 stages of trade development. So this is the theoretical structure of the 5 stages that one a trader must go through. The thing is, how do you flesh it out? So these stages have their own subsystems, if you will. So that's the roadmap in general. So how do we take it from theory to practice? So obviously you've got the first stage. This is the, as we mentioned, the self-knowledge. I created that for that. It's called
Self-evaluation.
Smart start. That's it's a basically there's a self-evaluation framework. And once you've produced that, then we go into the market knowledge and the action plan stage with how do you create systems. Now I've got a PowerPoint here I want to perhaps share with you.
Sure.
To make it a bit more less theoretical. So this is my framework, how to create strategies. So in the smart trader system, this is the strategy system. And then you've got the support system, all right? So for stages 4 and 5. So what is the strategy system? The strategy system basically is a multiple time frame and multiple factor roadmap. Multiple time frame because in my world there are 3 operating time frames: the monthly, the weekly, and the daily. And multiple factor because I believe that each time frame has its own return drivers. There are different things that affect the weekly chart, different factors that affect the monthly chart, and different factors that affect the daily chart, the daily time frame, if you will. So for monthly, I look at the economic statistics, the business cycle, and which is basically the intermarket cycle. For the weekly, I look at the commitment of traders report, sentiment, and seasonals. So this is my macro background. The fundamentals answer the question why. So once a market is set up, as filtered through fundamentals, then I go into the technicals. And I look at these factors, 4 factors. And once I've got these, then I build a strategy with a 4S framework, setup, signal, stop, and size. So at a high level, this is how I look at strategies or create strategies, if you will.
But let's say you need let's say you want to create a strategy. Now, you don't look at all the parameters in the macro. Well, the first 4 parameters, which is intermarket cycle, commitment of traders, sentiment, and seasonals, right? So you pick something that is relating to your overall strategy.
Good question. Right. Let's take a back step to answer this question from a different angle. My goal, my ultimate goal, if you will, I'm talking from a strategy or a trading point of view, not from emotional management point of view, is to have diversification. In order to have diversification, you can do it in through different ways. One is through time frames, one is through strategies, and the one is through markets. Trading different markets, different systems, or different time frames. So since diversification of strategies or markets or time frames is my goal, I have to create a way to achieve that goal. So in order to have different return drivers, so for strategies to be uncorrelated. So how do I do that? I have what I call a current satellite approach, which means there is a core part to my portfolio, which is long-term trend following. On long-term assets, they have an inherently upward bias, that is equity markets. And that is the investment vehicle for that is ETFs. And also a trend following for various other asset classes. This is purely price-based. The other one has got more fundamentals. So this is the core part of my portfolio, long-term investing through ETFs. The satellite part is short-term futures trading, okay, which is uncorrelated to the previous one because it reflects different return drivers. Now, going back to your question, so for the intermarket cycle stuff, for me, that is geared more towards the core part of my portfolio, the long-term investing with ETFs. Commitment of traders, I do that with futures. What do? I go into the weekly chart, see what the positioning for the large traders is, and then switch to the daily chart to take a position. I don't do it on the weekly chart. So that's one strategy. And then I can have various indicators for sentiment and seasonals and create other short-term strategies around that. So this is my return drivers for the fundamental strategies. And then I can go into the technicals for trend, relative strength, relative ranker, look at momentum and volatility, and create either filters for the fundamental strategies or have them as purely technical. But this will be my short-term futures trading strategies, if that makes sense.
Okay, so if we focus on the trend structure roadmap, so what is it?
Well, the trend
which is the first one in the technical.
Right. Yep. Okay, you picked the first factor of the technical, the trend structure roadmap. Well, this is one of the things I was taught from Larry Williams. The trend is the basis of all profits. So the trend is extremely important. I mean, there is a huge industry, CTAs, which is basically follows on trend following. So, but trends are operating sort of like if your watch, you've got the hours, the minutes, and the seconds. So in that respect, the trend also has its own time frames. I focus on I have a measure of long-term trend, and then I have a short-term trend. Now, and also you can have, of course, an intermediate term, but let's simplify it. Take two variables, not four, not three. So you've got the long-term trend and the short-term trend. If you take this, you've got four possible combinations: long-term trend up and short-term trend up. So that's stage one. You've got long-term trend up and short-term trend down. That's stage two. Then you've got long-term trend down and short-term trend down. That's stage three. And then long-term trend down and short-term trend up. That's stage four. So you go four different regimes, as it's called. So once you've got this roadmap of these four different trend regimes, you can plot the markets and see it like a roadmap and have a bird's eye view of all the asset classes. So even if you're following, so for example, say 30 or 40 futures markets, you can know exactly where they are, and you can start use it for your testing. Say this market is in stage one, this one is markets in stage three, this market is in stage one, stage four, for stage four being long-term trend down. For example, let's look at a very brief example. Yeah, well, crude oil for now is in stage two, is long-term trend up and short-term trend down. Now, there are many tools that you can use to flesh the let me put it. There are many tools. Of course, there are many tools. This is the basic framework. There are many tools how you can use. You can use moving averages. You can use. Basically, I prefer to do volatility stops. Now, newer traders, these call these like super trend, but for us old timers, we know that's basically volatility stop. But you can use many. This is my basic framework. This is the most important part from the technical to have the to know the trend. So I've got 4 different regimes. So once I've got that, I can start back testing strategies because, for example, my trend factor is quantified in 4 different stages. Then I've got 7 different ranges for the MACD, as we mentioned before. For volatility, I've got another 5 different ranges. So once everything has been quantified, it can be back tested. And that's one of the things I do. Everything has to be rules based.
So you based on the MACD, and the MACD is the
momentum,
not the algorithm, but the thing that you have discovered, right, in 2015.
Yeah, correct. There are 4. There are both technicals and fundamentals. I use 4 factors for each one. For technicals, I use trend, basically direction. Momentum, which is speed. So, for example, if you've got 2 cars and one is going north and one is going south, one is, for example, an uptrend or one is a downtrend. So that's your trend, basically. So for 2 cars that are headed in the same direction, one may be going 70 miles and one may be going 60 miles. So that's momentum. And I use the MACD to get that. Then you've got relative strength, which means, yes, they go at different speeds. But if you look at your car's dashboard, you've got not the speedometer, which is momentum, you've got also the odometer, how much distance they have gone. Because one may be going 70 miles, 160, but this one may have traveled a lot more because it was started earlier for some reason. So you've got relative ranking. So in that roadmap, you can see which market is stronger and which is weaker. And then, of course, you've got volatility. So these are the big factors of technical analysis: trend momentum, volatility, and relative strength. And everything has to be put in regimes and rules-based, so it can be quantified. There won't be any room for interpretation in that part. So, for example, according to my methodology, if you show the same chart to everyone should be seeing the same things. The market is an uptrend. It has this type of momentum. It is very volatile or has slow volatility, or classified according to. There shouldn't be any ambiguity, at least from an interpretation from that part. So that was one of the things I tried to do, is go from subjective technical analysis into quantified technical analysis.
Could you provide an example? How do you categorize? How do you categorize an asset to those 4 categories or 4 regimes?
According to trend, you mean, or
Yeah.
or any other? Yeah, it's very like a very easy. For example, look at the long-term trend and look at the short-term trend. So each of these can be up and down. So you go basically a 4x4, 2x2 quadrant. So it's a 2x2 matrix. So there can be 4 possible combinations. So for example, let's see, I'm looking at crude oil now. Long-term trend is up and short-term trend is down. So that's stage 2. Very quantified, very simple and very quantified. So I can do this for an X number of asset classes, and for each one I know exactly where they are. Now that can be the basis to start creating strategies, but it also, even if you don't want to be fully systematic and you're going to be semi-systematic, like a rules-based discretionary trader, you can use that as a code, as a rule set to know exactly what the market is doing, and base your decisions on that. And for example, you can start creating rules around that. Say, for example, I'll be taking my buy signals if XYZ rule is happening. So you go from forecasting to nowcasting, to being rules based. You're no longer seeking to forecast what the market does. You'll say, you're shifting your mindset from what if to if then. So if this happens, then I do that, rather than what will the market do. I don't focus on what the market will do. I'm focusing on what is happening now. I think some people call it now casting. I mean, you try to identify what it is rather than it will do.
Okay, and the last 4 parameters probably relating to risk management.
Yes. I mean, that's. Let me bring up the slide again. Perhaps that will make more sense. All right. So we said setup. Setup score basically is the the part when we set up the market. Setup means like the filter. So for example, if some 2 or 3 or 1 fundamental factor is providing a directional bias, then I'll be looking to take long or short trades. The setup basically is the filter that provides me if I'll be long or short. And there are ways to score the factors, because you have to start quantifying and say, okay, you see if it's bullish or very bullish. And then I go to the signals. I have a system who provides just entries and exits, but I don't take a signal just because there is a signal. It has to come in the context of a setup. For example, seasonals are good, sentiment is also bullish. So I'm looking to take buy signals, but I won't take buy signals just because it came there. So going back to your question, risk management has 2 parts. Obviously, is the stop and the size. Stop is when obviously where the where you will be placing your exit from the trade, worst case scenario, but also it can be also in the form of a target, depending on the type of trade. For example, if you want to be doing trend following, then you don't want to be using targets. You want to be letting your trade go as far as you want. As far as the market will allow you. Try to milk it as much as possible. But if you're doing short-term mean reversion, then you're better off to start going at a, say, volatility-based target, a few ATRs. So that's one way to manage risk on a trade basis. Also the size. Now, position sizing, I think it's probably the most important factor, and it can be done on various levels. The first level, of course, is at the position level, how much you're willing to risk per trade. Also, you must be very wary of your exposure per sector, because a mistake I often see, someone says, okay, I'll be risking, say, 50 basis points, or say 1%. A lot of retail trades gravitate around that. Say 1% per trade on the Dow. I'm long the Dow. Yeah, but then again, there are 1% the S&P, 1% the FTSE, 1% the DAX. Well, basically, they have a huge equity exposure, although they have said, okay, it's 1% per trade, but they're all part of the same theme. So you look at per asset class. You must also be aware of your risk management per strategy, and so there are various layers, if you will, of your sizing per portfolio, or again, without going into too much detail right now. So either both on a trade or on your general exposure, how much you can risk.
Got it. So let's go back to how do I approach the markets, for example, because you created a roadmap for a trader that want to start this journey. And so first of all, it's self-evaluation, and then the markets and so on. So let's focus about the market. So how a trader that just start like today, right? How should he approach the markets? How should he, if you would approach to young Alex, what would you say to him?
Well, again, supposing that we had done the self-evaluation process, we've cleared that stage, then I would take him through that roadmap step by step. Each step would be rules based. So the first thing to do is to understand the theory. Start with the fundamentals and then go into the technicals. Understand the theory, why that is important, and secondly is how to do it. For example, learn the rules. For example, we said about the trend being classified in 4 stages, momentum having 7 stages, and so on and so forth. So make sure he understands the theory inside out. And then we would go into practice, which is if we know Pareto's principles 80-20, learning it is the 20%. 80 is the application. So we would switch from information to implementation. And the roadmap that I gave you, I will be very soon be giving it out for free, all the modules and things, because I don't want to be focusing on information, but on implementation. So everyone will have it, will be publicly available, because I want to be focusing more on implementation. So that's where the really, really important and the part that most people miss. It's the implementation. So this is where we would go in and start working on the sim, start working on the execution skills, start setting up performance criteria for them to go live. So and then do that for one strategy at a time. Because if you were for example, you want to be learning let's say the strategy based on the commitment of traders report. Okay, focus on that one, and then you can start adding rather than going from one shiny object to the next. So this is what I would do. It would be a lengthy process. It's not something that can be done overnight. I would ask them to say, okay, that's why the valuation comes in. I would ask them, can you do this for a year? Because that realistically, that's how long it's going to take.
I would like to ask you some questions.
Of course.
Now,
go ahead.
First of all, I would like to see one strategy that you have been able to construct the way that you present to us with, and it went incredibly good and incredibly profitable to you by the end of the day. And
yes,
that's really the way to construct a great strategy. But there is a gap that we will need to bridge here, because if we would like to make the conversation fruitful, we will need to convert to convert that conversation to a strategy that you have been built in order for that makes money.
of course. Well, we can start from things that have already publicized. For example, the paper that we did for the MACD, and there I have written quite a few strategies, both on a systematic and a semi-systematic basis. So let's take the MACD. A very simple strategy, two components. One was
You share a screen?
I don't have that with me, but you can go to, if you go to SSRN, the website where it holds papers,
One sec, I will.
Yeah, you
How
will
it's called?
Google
SSRN.
It's a website that holds research, academic research.
Okay, yeah.
All right. Yeah, well, if you Google my name there or MACD, you will find the paper. It's publicly available. It's about 45 pages of research. Everything is very quantified there. Let me, perhaps I can bring it up myself. Just give me a second.
So you have a PDF, 43 pages from the National Association of Active Investment Managers.
Yeah.
All right. Let's go over the strategy. Let's go over the strategy, guys.
Okay. Let me try to bring it up on my, because obviously I don't remember all the findings by heart. All right, got it. All right, fantastic. So let's go over some paper. The paper again, it's 45 pages. Let's go into right
I can show
strategy.
it.
Yeah, absolutely. All right. So let's go down to page, and I'll tell you
One
exactly
sec.
where you can go. So all right. So on page 12, I have quantified the the ranges for the PPO, and then we go. Give me a second. Exactly. All right. Okay. Let's start testing it from. Let's go to page 19. When I check out the MACD across markets. And if you go actually to page 20, I've got the ranges. Now, what I've done here, for example, this is how you can create a strategy based on that. Right. So you've got the maximum and the minimum values that a free unbound indicator can take, and try to see what are the ranges, the oscillations of this indicator. So having set the ranges at 50 and minus 50, 150 to the upside and 150 to the downside, what I try to do is quantify how much is 5% outside of the top range and 5% below 95 within the range. So having had a statistical analysis of what are the ranges for this indicator, then what I do, if you scroll to page 22, then you'll start dissecting the indicator behavior more. So 150, 50, minus 50, 150. So you can see that the indicator goes above 50 4% of the time, 1% of the time below 150, and I can do for 3 asset classes, S&P 500, Bund, and also natural gas. So this is the very first simple exercise. Now, if you go to page 24, if you scroll to page 24, I do the same exercise, but using a regime filter. Now, this is what gets really interesting. So what I try to do here is take a regime filter, a very simple regime filter. For example, in this particular example, I quantified it using the 200-day moving average. And what I try to do here is what is the range that the indicator, range of values the indicator has using using this regime filter. And what we found here is that in the low 99.4% of the occurrences of the values, if you go scroll to page 24 is actually
24?
above, I think it's above, yeah, there you go, is above minus 100. So what does this mean? Although the value can be of the indicator a lot less than that. So as long as the indicator, as the market remains above the 200-day moving average, then 99.4% of the observations are above minus 100. So coming back to your question, one setup and one very interesting pattern and strategy is the close of the market being above the 200 moving average and the MACD being below minus 50 and above minus 100. And you can see the statistics of the strategy. It works both to the upside and to the downside. I mean, I saw we did the same study when it is below the 200-day moving average. So if you scroll forward on page 24, same numbers for the Bund from 1991 to 2021. 98.9% of the values were above, were statistically significant. I mean, the values were above minus 100 for the Bund, which is roughly the same as it was for the S&P 500, and also symmetrically when the market was below its 200-day moving average. Now, if you scroll down to page 25, I did the same study. You'll find the page number on the bottom right part of the paper. Yeah. So I think this is on page 25. So you go there, you'll find the MACD ranges for this trend regime filter for natural gas. And again, the numbers here are 99.5 and 99.8 respectively for bearish and bullish markets. So page 25 will give you a visual of this particular strategy. So the strategy, to recap, is MACD above 50 and between 50 and 100, and the close being below the 200-day moving average. And symmetrically, you've got that to the downside. Now, scrolling forward down to now you also use swing charts, different swing charts to verify this, and then you can use this as a nucleus for different strategies. This is purely technical, based on momentum and trend. It's a two-factor strategy. You can also use a second trend regime filter. That is in page 30. This trend regime filter was inspired by Chuck Dukas when I used a more demanding, if you will, strategy for defining the trend, which is basically the 50 and the 200-day moving average. So if you take the combination of this, you've got six different regimes. And again, I studied the behavior of the indicator in each regime filter, because according to each regime, you have different values of the indicator that it manages to stretch itself. And when that happens, that means you have different overbought and oversold levels, which are basically trend defined. And that is a very important point, which means when you are above the 200-day moving average, the indicator will bottom out in different levels than when it is below the 200-day moving average, or it will bottom out in different levels when the 50 is above the 200. So that's what you've got, the ranges. And so on and so forth. Again, if you scroll down to, again, you can find the statistical verification of that.
Yeah, in page 41.
Sorry, page 41. Well, let me see where you scroll down to. All right. Yeah, I was trying to explain stuff in page 35, but let's scroll down to 39. Yeah, that's page 39. Basically, is Linda Raschke's.
This paper is until page 43. 42, actually.
All right. So I'm not sure. I kind of lost you. Let's try to take this step by step. Okay, let's go to page 39 when it's titled "Teaching New Tricks to Old Tools."
For Alex, I'll do Impulse Plus system.
Actually, it's above that. It's page 39. You can see the pages at the bottom right corner, not the one that it's in the counter of Word, because that's also counting the cover.
No, I'm
yeah, that's the one. That's the one. Yeah, there you go. LBR.
This one?
So this is basically Linda Raschke's indicator, which has also been again improved and quantified. Then also we also use this Alex Elder's Impulse Plus system.
Plus system. Yeah.
Yep. If you scroll down now to the next part,
you have
this is Chuck Dukas' Diamond Refined. Again, this is another system that you can use. This is on if you stop here, it is basically on a weighted condition scoring, where basically you take the various MACDs, basically expressed the relationship of price versus each moving average as a function of a MACD. So basically close versus the 50 is expressed basically as a MACD. Well, MACD 150 is basically the close over the 50. And I use the weighted condition scoring system where the MACD 150 is 1 point. MACD 1200 is 2 points when it's above 8. And the MACD 50-200 is above 5, is 3 points. So with that, you can use it as a regime filter, momentum regime filter. Again, using weighted condition scoring. And if you scroll down, this is another system, the 70-70 system. I use that on the DAX. Again, all the numbers are below that. There are many ways, and this is just how I quantified one factor, just trend and momentum. And this is, I think it's quite, I would say, basic work. I mean, there's a lot of things you can do way and above and beyond that.
Yeah, definitely. Alex,
There's a lot of things
really
you can.
Yeah, for sure. Really, I mean, there was endless strategies that you can build with it. I mean,
just using the regime filters that you can use, for example, using the range rules with the MACD versus trend. I mean, the possibilities there are a lot. Because one thing we did not touch upon with the MACD is if we use a swing filter. Because if you start using, for example, a 5% swing filter for the S&P 500, you can notice when are the bottoms of the market versus the S&P versus the ranges of the MACD. So using that, you can start making guesses of when the market will bottom. Of course, that is purely from a statistics point of view. It doesn't mean that the market will bottom there, but it goes to show you that there is a tendency. If the market holds this level, then that will most likely be a price of short-term bottom.
Got it. And you've obviously combined this with the fundamentals and also the technicals, and then you have a working strategy, as you said.
Yep.
After applying also the risk management, the stop, and
exactly. So this is an example of the quantification of two factors: trend and momentum. But you can do that for any type of factor, as long as you dissect it in different regimes. Then you can start applying it, say defining by if it's high or low, or so on and so forth. So for example, the MACD, you've got 7 different ranges and different types of behavior. So when a market is so-called what we call overbought, the risk range is when the market is above 150. That means it's 1.5 times its volatility. Or if it is above 50, the MACD is above 50, means that it is going through a rally. It's rallying.
Got it.
Or you can also quantify how it can be in a trading range when the MACD is between 50 and minus 50 for more than 20 bars.
Yeah, endless strategies you can build with. The more thing is to test it. That's the
exactly. If it's quantified, then it can be if it's quantified, then it can be definitely be tested. And of course, coming back to your previous question, if it can be quantified, then it can be also be taught, because it's rules based. So for example, if I say to someone, you take a deep dive, or take deep corrections when the market, for example, is above the 200-day moving average and the MACD is below 50, minus 50, then that's a rules-based strategy.
Got it. Okay. Well, there was definitely going to be a part 2. I feel going to be.
Well,
part 3.
there is a lot of things, because the thing is, again, like what we showed today is just a small part. It's just the strategy system, how to create strategy, but it's also how to implement them, which I think it's more important, because of course this might be the first point of impact on how to see this for the first time, but how you actually implement it, that's a different, that's also a story in and of itself.
Yeah, for sure. Okay, Alex, thank you for coming and sharing your valuable insights and information about the markets and so on. Really, I appreciate it. Thank you.
Absolutely. Thank you so much, both.
We'll meet in the part 2 episode. Definitely. Thank you for your participation, Alex. It was a great time listening to you. What do you experience? Thank you.
Thank you both so much.
No problem.
Take care. Bye-bye.